Welcome to Purdue Commercial AgCast, the Purdue University Center for Commercial Agriculture's podcast featuring farm management news and information. I'm your host, James Mintert, Emeritus Professor of Agricultural Economics here at Purdue University. And joining me today is my colleague, Dr. Michael Langemeier, who's the Director of the Center for Commercial Agriculture and also a Professor of Ag Economics here at Purdue. We're going to review the results from the October 2025 Purdue University CME Group Ag Economy Barometer survey of farmers from across the nation. Each month, we survey 400 farmers across the U.S. to learn more about their perspectives on the ag economy. This month's Ag Barometer survey was conducted from the 13th through the 17th of October. And Michael, the Ag Economy Barometer Index actually rose a little bit this month. It rose 3 points to 129, but that still leaves the index 29 points lower than it was in May, which was the index's high point so far in 2025. And a year ago, the index was just 115. So it's 14 points higher than it was in October 2024. And when you look at the index of current conditions and the index of future expectations, they were both up this month. The big mover was the current condition index, which was up 8 points to a reading of 130. That's 16 points, however, below its 2025 peak of 146, which was back in May. And the future expectation index was up, I think, 1 point, so kind of a trivial move. And that October expectation index was down 35 points from its 2025 peak, which was also back in May. So when you look at the change, a fairly small change in the barometer itself, a bigger change in the current condition index, what's your take?
I spend quite a bit of time thinking about the relationship between those two. And there's obviously times like we saw in late 24 and early 25 where the index of future expectations was quite a bit higher than the index of current conditions. But the fact that they're the same tells me that the tight net return scenario that we're currently in, they expect that to persist. That's what it's telling me. If you dig deeper, we're going to talk more about this, but you dig deeper and you look at livestock and crop, the crop people think their situation is probably going to persist for a while. The livestock people similarly think their situation, which is much different. They're facing a much brighter scenario right now. They're expecting that to persist.
Yeah, I agree with you, Michael. And the other thing, though, that I think is interesting is the fact that current condition index and the future expectation index, they're both substantially higher than they were this time last year. And given where we're at with respect to especially crop prices, that's a little surprising. And, you mentioned, as we're going to talk more about it, there is the impact of the livestock sector showing up here, but still it is kind of interesting.
I think again, we talked about this many times before. I think it's that they're still fairly confident in that long-run policy environment, that the trade and tariff situation we're in is a lot of people think that's going to turn out in our favor. And we'll talk about that here a little bit later, but that makes a difference, particularly when you're looking at the index of future expectations.
Yeah, good point. So looking at some of the raw responses to questions, would you say that your farm operation today is better off, worse off, or about the same financially compared to a year ago? And, this really kind of illustrates what's going on. The worse off category is really up sharply since May. That was up 2 points this month, but it's 21 points higher than it was in May. And we're at, 49% of the people in the survey saying worse off. So that kind of, I think, tells the tale a little bit. And then you mentioned the difference between livestock and crop producers. The question says, over the next 5 years, are widespread good times or bad times more likely? And we differentiate that based on livestock and crops. On the livestock side, 70% are saying good times. And on the crop side, only 30%. And, that really trickles through a lot of our results, this difference in the perspectives that people have on the crop side versus the livestock side.
Yeah, it's extremely important. And certainly all the indices would be down, both the Ag Economy Barometer and both of the sub indices would be lower if the sentiment wasn't really positive for the livestock sector.
Yeah, and I think that's underappreciated. I think it's probably worth pointing out that when we do our survey every month, by design, this is based on the value of farm production from the U.S. Census of Agriculture. By design, 19% of the people in the survey have a beef enterprise. And when you bring in dairy and hogs, we wind up at about 25% of the people have a livestock enterprise. And that has had a big impact because the livestock situation is so much different, especially on the beef side, than it is in the crop side.
Yes.
Farm Financial Performance Index dropped back 10 points in October to a reading of 78. That puts the index 31 points lower than it was in May. And, I'm not surprised by this, right?
I'm not either. It looks like 26 is going to be another tough year.
One of the questions we added this month was in previous surveys, producers have told us overwhelmingly that they think USDA is going to make a market facilitation program type payment. I think last month it was 83% said that was either likely or very likely, and I think 62% said very likely. So this month we asked if USDA provides a market facilitation payment to compensate for weak commodity prices, what will be the principal use of this payment on your farm? And over half the people in the survey said they'd use it to pay down debt. That was 53%. Another 25% said improve their working capital position. So 78%, almost 8 out of 10, are probably doing what a good farm management advisor would tell them to do, right?
Yeah, both of those strategies are very logical. We did not distinguish between paying down operating debt, paying down, a non-operating debt. But my guess is probably both.
Yeah,
they'll probably pay down some operating debt if they have some operating debt that's going to be left over after harvest. And that by itself is probably going to improve working capital. But they're probably also going to pay some of that long-term debt down.
And I know there's a lot of interest in the farm machinery industry about what people might do if they get a significant MFP payment. 12% said that they would invest in or use that money to help update their farm machinery. So that's a fairly small percentage, but it's not zero. And then 11% said they would use it to help cover family living expenses. So we suspected, I think, from a managerial perspective, that we would see a lot of people say they were going to pay down debt. That's a good thing, I think, in terms of maybe improving the stability of the sector. The Farm Capital Investment Index was a little bit of a surprise this month. It rose 9 points to a reading of 62, and that essentially offset last month's decline. The percent of respondents who chose good time to invest rose to 24%. That was up from 18% in September, while the percentage who chose bad time to invest fell 3 points to 62. And again, some of the rise in this index has to be attributable to the livestock sector.
Yeah, we didn't put in the report, but I actually summarized that in the spreadsheet. And the Farm Capital Investment Index for livestock was 80. That compares to a much lower index for crop. And so I definitely think the livestock sector helped improve this number.
Yeah, and I think that's widely misunderstood. And again, thinking about how many people in the survey have a significant portion of their farm income coming from the livestock sector helps explain these results quite a bit. Little follow-up question about farm machinery purchases in the upcoming year compared to a year ago. That's a question we ask every month. And the percentage of producers who say it's a bad time to invest has declined 3 months in a row. And they've been shifting over to the stay about the same category. So that's actually sort of consistent with what we're picking up on the investment side a little bit in terms of the direction, maybe not the magnitude. Yes. So the short-term farmland value expectation index at 113 was up 7 points compared to September. And maybe more importantly, that broke a pattern of declining index values going back to June. So, we've been coming down every month and been tied pretty closely to the margins that have been tightening in the crop sector. So how do you explain that bump up this month?
Every month there's a couple surprises, and this was a bit of a surprise to me. Particularly the short term. You look at the net return prospects for crop producers; they don't look any better than they did in September or August or even July, for that matter. And so that's really not explaining it. And so this was a bit of a head scratcher. Now the long term. We're also going to talk about here, that one to me makes some sense because one of the things that's been going on is people have flocked to gold and silver. And so they flocked to physical assets. Well, land's in that category. If you think about an inflation hedge, if people are really worried about inflation in the future, it's gold, silver, and land, farmland are the assets that people typically invest in. So the fact that the long-term farmland value index increased rather dramatically is not as surprising to me as the short run increase.
Yeah, the long-term index at a reading of 161 actually jumped up 15 points, and that matched its highest value at 2025. So I'm gonna disagree a little bit, Michael. I was surprised. I would have not. The fact that it went up didn't surprise me so much, but the fact that it matches the high value of the year, that did surprise me.
Yeah.
And it's a little puzzling, but I guess both of us think it is tied to somehow to this idea that we're going to see some inflation. And historically, farmland has been a relatively good hedge against
Yes.
inflation. I certainly view it as
Yes.
you're actually more of an expert on that. It's certainly viewed as a hedge against inflation. From a really long-term standpoint, it is a good hedge, but not necessarily in the short run.
Yeah, not necessarily in the short run, but Dr. Baker, Dr. Bulgy, myself, along with a graduate student a few years back, actually looked at whether gold and silver was a better hedge against inflation or farmland in the long term, and farmland actually was better.
Yeah.
Now, short term, it doesn't do as well explaining short term movements. No.
And it also has the advantage of actually offering a dividend every year.
Yes.
Unlike gold,
Yes.
which just sits there, right? So, all right. We've been asking this question for a long time, going back to 2019. Over the next 5 years, do you think ag exports are likely to increase, decrease, or remain about the same? And there was a bit of optimism this month. It's a small amount. The percentages said that they expect to see exports increase, rose to 51%. That's up from 47% last month. The percentages said they think it's going to decline, changed a little. It went to 14% from 13%. The interesting thing, Michael, is when I look at a chart, the line that plots the percentages say they think exports are going to increase has been increasing now for about, 6 months or so? It's got a strong uptrend.
And if you go back before the 24 election, it was actually 10 points lower. That's a bit surprising to me.
Given what's going on
Given
with
everything that's going on, that they're actually more optimistic regarding exports in the next 5 years than they were before the 24 election.
I mean, exports to China have fallen off a cliff.
Yes.
I mean, that's
there's
the big
zero
one.
for soybeans right now.
Yeah, so that's this is a surprising result, but it does speak to the attitude of what people are thinking about out there. And the follow-up question we've been asking just recently, I guess we started asking this in April. Do you expect the increased use of tariffs by the U.S. to strengthen or weaken the U.S. ag economy in the long run? This month, 58% said strengthen. That's up from last month. Last month in September, it was 51%. In June, it was 63%. In the spring, it was 70%. So there's maybe been a fall off in confidence since the spring. And then what I'm going to call the uncertainty factor is definitely up compared to the spring. In the spring, only 8% said they were uncertain about the outcome of the tariff policy. This month, that's doubled at 16%. It's down slightly compared to last month. Last month was 19%. But when you go back to the spring versus now, the uncertainty factor has definitely risen.
Yeah, you point out a very important point here is the last 2 months, that uncertainty index is double compared to even what it was in April, May, and June. And this is a question I definitely think we should ask again in November and December to see if this changes.
Yeah. We've been asking this question, I think, for a long time as well. Looking ahead to next year, what are your biggest concerns for your farming operation? Not a lot of change here. Higher input cost is still the number one choice. This month, 41% of the people in the survey said that was their top concern. 28% said lower crop and livestock prices. Those are both a little higher than they were at the beginning of the year, but not a big change. Last month, we did highlight the fact that we saw a bump in the people worried about the availability of inputs. It was up around 15%, which was the highest we'd seen in a long time. This month, that dropped back to 9%. And we wondered last month if that 15% was kind of a blip. Based on this month's results, maybe it is a blip. Do you agree with that?
Yes, it does look like it is, because it's no different than the January number, 8%, 9%. They're not significantly different. One thing that's always interesting about when you look at the answer to these questions, when you read the Farm Press, for example, and you listen to podcasts related to the farm community, they tend to focus on policy. And I just want to note here, this hasn't changed all year, but only about 11%. Their biggest concern is policy. So that tells me that they're pretty confident that the policymakers are probably going to come through. But if we need some additional government payments or something like that, they're worried about the fundamentals. And the fundamentals to me are where are prices relatively low for the crop sector, relatively high for the livestock sector, and then those high input costs that are with us ever since COVID ended. So I find that fascinating that they really focus on the fundamentals.
Yeah. we've talked about this before. I think we've both been a little bit surprised at the fact that how few people focus on the policy side. We've got it broken up into two questions or two responses. One's farm policy, and this month it was only 6%, and that's about where it's been all year long. Environmental policy was at 5%. That's a little lower than it was at the beginning of the year. It was 8%. It's been as high as 9%. So that's a small percentage. And yet, in an era of low prices on the crop side, farm support coming out of farm policy is pretty doggone important. And so it is surprising that we don't get more people focused on that. We added some extra questions this month, basically to try and learn a little bit more about what people are thinking about in response to lower prices for the crops, and more specifically, in this case, corn. So the first question we asked was, does your farm use advice from an agronomic consultant when making decisions? And 52% said yes, 48% no. We were talking about this before the podcast. I was a little surprised at the 52%. I expected a somewhat higher number. I didn't expect 100%, obviously, but I thought a little higher than basically a coin flip.
I think there's a couple of things going on here, as we were talking about before. One of them is, who do they call an agronomic consultant? Is that a full-time person that comes to the farm and helps them, for consulting fee, or is that a person from the co-op that's maybe providing that service for very low cost or even free? Are they both considered agronomic consultants? And so we're a little vague with this question. But also, we got to remember, we've got quite a few mid-sized sole proprietors in here that probably don't have a consultant from either source.
Yeah, that's a good point. We'll probably ask this again at some point in the future. I'm looking at maybe phrasing the question differently would matter.
And we also asked a question related to financial ratios, and it was about half the people use financial ratios. Again, we're probably a little vague. My guess is as folks use the current ratio and debt to asset ratio a lot more than the profit margin. But about 50% used financial ratios in their business.
So then, following up that agronomic question, we said, what changes, if any, will your farm make in 2026 to respond to low corn prices? And 30%, so roughly 3 out of 10, said they were going to make no change. The next was reduce phosphorus rates. And we only asked about phosphorus, not potash. My interpretation is that was probably like reduce dry fertilizer rates or reduce rates on fertilizers that we don't necessarily have to apply every single year. That was chosen by 29%, so almost the same as no change. Adopt lower cost seed traits was chosen by 27%, so again, almost 3 out of 10. And then the two that really dropped back quite a bit, reduce nitrogen rates was only chosen by 16%, and reduce seeding rates was only chosen by 11%. So what were your expectations coming in on this question?
I thought the changes would be a little smaller than what we're seeing here. But having said that, I think it's very logical that people think about lowering their seed cost versus traits and choosing traits and varieties rather than the seeding rates. That makes a lot of sense to me. Reducing seeding rates the benefit there may not be as big as the cost, quite frankly. And so that one's always a little tricky. And it was very logical to me that the P rates, a lot more people thought about reducing P rates than N rates. And perhaps one of the things that's going on here when you look at the fertilizer results is fertilizer prices are relatively high right now, particularly for phosphorus, but also nitrogen. Compared to last year at this time, it's higher. And so I think that is in people's minds. Is there anything I can do to try to reduce my fertilizer costs, this year? And they're indicating that they're going to look at those rates carefully.
Yeah, and I guess my interpretation of this question is not that necessarily people are going to follow through on all these things, but rather they're thinking about them.
You're thinking about that.
They're thinking about ways that I could do something to reduce my cost per bushel.
To get that break even a dime or 20 cents would make a lot of difference.
Yeah, and so I suspect a lot of the folks that responded to this question, probably these are things they're thinking about. They probably haven't made a final decision on what they're going to do here. So question we've been asking since July is, would you say that things in the U.S. today are generally headed in the right direction or on the wrong track? And boy, if we've got a question that we get consistent responses to, it's this one. 72% said right direction, there's been almost no change in this, right? Last month it was 71%, in August it was 69%, and in July it was 74% saying right direction. So again, you're thinking back to that, some of the things people are thinking about with respect to looking ahead, uh, index of future expectations, for example. People are on board with the policy direction that's going on. We hear a lot in the farm press and recently the non-farm press about complaints, but fundamentally, people think this is going to turn out okay in the long run. In the short run, it seems like the complaints that we're picking up are revolving around the need for something like the MFP program. You agree?
That's been consistent all year. We've asked questions about whether they expect MFP payments. A few months ago, they said yes, and so it's been very consistent throughout the year. And this question we've been asking since July, like you said, is extremely consistent. I don't think that's necessarily the case with the non-ag community. I think this has been asked with the broader U.S. And I think there's more variability when you ask that, but for the ag community, very consistent response to this question.
It's probably the most consistent thing that we've done, right? But I think
Yeah.
it's kind of a policy zone like this. So, when you think about responses, we've got 4 months of data now that's a little over roughly 1,600 responses, and they just haven't changed at all. So that's kind of interesting. Well, that wraps up the highlights of this month's Ag Barometer survey. You can get the full report on our website, which is purdue.edu/agbarometer. And of course, if you're watching this on YouTube, you can also get more details on a regular basis from Purdue Commercial AgCast, which is available on major podcast providers and at purdue.edu/commercialag. I want to emphasize you don't have to subscribe to this on a podcast provider. You can simply listen to the podcast on the website itself. So with that, I want to thank my colleague, Dr. Michael Langemeier, for joining me today. And on behalf of the Center for Commercial Agriculture, I'm James Mintert.